Good morning, students. Today we will be solving problem on scope of total income. Scope of total income. Okay. Before we go into the problem, let us revise the theory that is needed to be revised for this section. Okay. Now we saw that there are six incomes. There are six types of income: received in India, income deemed to be received in India, income accrues or rises in India, income deemed to accrue or rise in India, income accrues or rises in India from a business in India, accrues or rises outside India. These are the six incomes which are taxable in the hands of a resident and only resident, resident but not only resident, non-resident. Now we will see what are the incomes taxable in the hands of different groups. If you are a resident and ordinary resident, then the six incomes are taxable in your hand. All six incomes are taxable in your hand. Income received in India, income deemed to be received in India, income accrues or rises in India, income deemed to accrue or rise in India, income accrues or rises outside India from a business controlled or a profession set up in India, and lastly, income accrues or rises outside India. In short, the world income is taxable in the hands of a resident and ordinary resident. Hope you got it. Now we go to the second one, that is resident but not ordinary resident. In the hands of resident but not only resident, five incomes are taxable: income received or deemed to be received in India, income accrues or rises or deemed to accrue or rises in India, income accrues or rises from a business control or a setup, a profession set up in India. These five incomes are taxable in the hands of a resident but not only resident. But if you are a non-resident, in this case, look, four incomes are taxable: income received in India, income deemed to be received in India, income accrues or rises in India, income deemed to accrue or rises in India. Only Indian income is put to tax in this case. Clear? Okay, once again, if you are a non-resident, income received in India, income deemed to be received in India, income accrues or rises in India, income deemed to accrue or rises in India. If you are a resident but not only resident, one more income comes, fifth one. All five incomes. Income accrues or rises outside India from a business controlled or a profession set up in India. These five incomes are taxable in the hands of resident but not ordinary resident. If you are a resident and only resident, one more income comes. Income accrues or rises outside India, thereby world income will be put to tax. With this in mind, okay, then we will be able to solve problems. Let us look at one problem. From the following income of Mr. Suresh for the previous year 2019-20, compute total income for the assessment year 2021. If he is a resident and only resident in India for the assessment year, a resident but not only resident in India, a non-resident for the assessment year. Clear? Now, first one, profession from business in Dubai, managed from India, 10,000. Royalty from Indian company received in UK, 20,000. Rent from house in UK received in Spain, 30,000. Dividend from British company received in Mumbai, 40,000. Interest credited to Bank of India, Delhi branch, 50,000. Income earned in Brazil in the past brought to India during the year, 60,000. Income accrued in New York and received in London, 70,000. Clear? And last one, income from agriculture in Sri Lanka received in India 80,000. Clear? This problem we will solve now. Yes, we need to consider him as a resident and only resident in India for the assessment year. Resident but not only resident, resident and non-resident. Okay, all three cases we need to consider. Okay, I hope you got the problem. Assessment year is 2021. Then we can calculate the previous year, that is 1920. Now before we solve the problem, let us go through one by one item and let us find out which category it comes. Okay, first one, profits from business in Dubai managed from India 10,000. Profits from business in Dubai. Business is in Dubai, yes, but managed from India. But the management is done in India. Which category this comes? We had 6 categories. Income received in India, income accrues or rises in India, income deemed to be received in India, income deemed to accrue or rise in India, income accrues or rises outside India from a business controlled from India, income accrues or rises outside India. Which category it comes? This will come in accrues or rises outside India from a business controlled from India. So this comes in the 5th category. So 5th category, 1, 2, 3, 4, 5 items are taxable in the hands of resident and only resident, resident but not only resident. Therefore, this item is taxable in the hands of resident and only resident, resident but not ordinarily resident. Clear? We will go to the next one. Royalty from Indian company received in UK 20,000. Royalty in Indian company. Okay? Yes. Royalty in Indian company means received in UK, not received in India, but it is in royalty from India. That means income accrues or rises in India. Income accrues or rises in India because it is an royalty from an Indian company. Next one, rent from house in UK received in Spain 30,000. Rent from house in UK received in Spain. Accrues or rises again outside India. If income accrues or rises outside India, that is not taxable in the hands of non-resident. It is taxable even not in the hands of resident but not only resident. Accrues outside India is taxable only in the hands of resident and ordinary resident. 4th one, dividend from British company received in Mumbai 40,000. Income accrues outside India, but it is received in Mumbai means received in India. Income received in India, if it is a first receipt, taxed in India. Therefore, this is received in India and taxable in the hands of all 3 associates. Next one, interest credited to Bank of India, Delhi branch 50,000. Interest credited to Bank of India, Delhi branch 50,000. This is accrues or rises in India. Accrues or rises in India or credited to bank account. So you can say that it is received in India. Received in India. Clear? Okay. Income earned in Brazil in the past brought to India during the year 60,000. What about this? This income accrues or rises outside India but not now, not in the previous year. We saw the condition that the income must be earned in the previous year. This is not of the previous year. It's brought to India. This is a subsequent receipt. So therefore, this cannot be considered as income received in India. Therefore, this item is not of the previous year. So this cannot be taxed this year. Okay. Income not earned in the previous year. So not taxable. In all 3 cases, we will not tax this item. And next one, income accrued in New York and received in London. Accrues or rises outside India, received outside India. Income received outside India, accrued or rise outside India. Okay, income accrues or rises outside India is taxable in the hands of resident and only resident only. Last case, income from agriculture in Sri Lanka received in India 80,000. Income from agriculture in Sri Lanka received in India. Income received in India, therefore taxable in all three cases. Got it? Got the explanation? Now let us solve the problem. Okay. So calculation of gross total income of so and so. Okay. Well, let us have 5 columns so that you understand this. For the time being, keep all these columns. 7 columns. First column is serial number. Second is details. Then amount. Then reason. Then 3 columns for resident and only resident, resident but not only resident, and non-resident. First case, profits from business in Dubai managed from India. Amount, you write in 10,000. Accrues or rises outside India from a business controlled in India. Therefore, the amount goes to first 2 columns. Clear? Okay. Resident and only resident, resident but not only. Second case, royalty from Indian company received in UK 20,000. Accrues or rises in India. Yes, this is accrues or rises in India. So taxable in all 3 cases. Third one, rent from house in UK received in Spain 30,000. Accrues or arise outside India. So it is taxable only in the hands of resident and only resident. Fourth case, dividend from British company received in Mumbai. Income received in Mumbai, therefore received in India, taxable in the hands of all 3 assessees. All 3 cases. Fifth one, interest credited to Bank of India, Delhi branch, 50,000. This is income received in India, therefore taxable in all 3 cases. So, sixth one, income earned in Brazil in the past but brought to India during the year 60,000. Income not earned in the previous year, so not taxable now. Over. Clear? That's not taxable in all 3 cases. Next one, income accrues in New York and received in London, 70,000. Accrues or rises outside India, taxable only in the hands of resident and only resident. Clear? Last case, income from agriculture in Sri Lanka received in India, therefore taxable in all 3 cases. Clear? Got it? So when we total, we get 3 lakh, 2 lakh and 1 lakh 90,000. Look, if you are a resident and only resident, your tax liability will be more. 3 lakhs will be your total income, gross total income, and on that you need to pay tax. Resident but not only resident, your income goes to 2 lakhs less than resident and only resident. Clear? So tax will be on that. If you are a non-resident, the least, only 1 lakh 90,000, your tax liability becomes less. Got the point? Got this problem clear? Hope you understood. Similar way we need to solve